Throughout your life, have you ever asked yourself, how much money can I actually make? Or what will my total net worth be by the end of my life? Many people don't have clear answers to these questions because they've never truly understood money. Meanwhile, the wealthy have a completely different perspective on it. Here's the core difference. Never think that you truly own money. In reality, money always belongs to the country. Your job is to legally bring it into your pocket, keep it moving, and make it work for you. The wealthy don't hold on to cash, they invest in assets and keep cash flowing to generate passive income. Cash flow is the lifeblood of any business or individual. While many people focus on accumulating money like saving it in the bank, the rich always look for ways to keep money circulating, because money that just sits idle does not generate value. On the contrary, it gets eroded over time by inflation. Inflation is a silent thief. Parents who spend their whole lives working hard and saving up for their children often pass away, leaving behind money that has lost much of its value. What once could buy a house may now only be enough for a bathroom. This is a clear example of how money loses its worth over time. The rich don't think in terms of owning money. They think in terms of having the right to use money. As long as the money is flowing through their hands, they can keep making a profit. Whether by starting a business, investing in assets, or applying financial strategies, the key is to keep cash flow alive. Cash is like water in a stagnant pond. If it sits still too long, it rots and loses value. But if you know how to create movement, that water can spin hydroelectric turbines, irrigate fields, and generate value. That's the cash flow mindset you need to adopt. What's the difference between the wealthy and a gambler? The answer might be surprising. It all comes down to how they use money. Gamblers use money to take chances, while the wealthy use money to buy assets and create passive income. The rich always look for ways to optimize cash flow by leveraging financial tools. A typical example is borrowing money to buy real estate or other income-generating assets. The poor worry, what if housing prices drop? Or what if I can't pay off the debt? Meanwhile, the rich think, what if money loses value? Or what if I don't use money to invest? They understand this core principle. The real value of money lies in its ability to generate returns. Money left in a bank might earn 2% per year, while investing it could yield 10–20% or more annually. The wealthy also understand the concept of tax optimization. Instead of paying high income tax as individuals, they operate under business entities to claim expenses and depreciation. This legally reduces their tax liability. In fact, investment assets can be recorded as business expenses, lowering taxable profit. In short, the rich don't think save to become wealthy. They think keep cash flow alive to become wealthy. They see money as a tool, as water, and they build systems to manage and extract value from its flow effectively. Money is not just paper bills or numbers in a bank account. At its core, money is trust. It exists and holds value because people collectively agree that it can be used to exchange goods and services. As long as a community accepts it, anything can become a currency. A clear example is in online games, credit card reward points, or even cryptocurrencies like Bitcoin. You don't have to pay to play games like Arena of Valor or Honor of Kings, yet the companies behind them make millions of dollars selling virtual items. These items have no intrinsic value, but because players are willing to spend real money on them, they instantly gain financial value. Game currencies can be bought with real money or earned through in-game activities. Over time, they become internal currencies, and if there's a system to convert them back into real money, they can effectively be treated as real currencies. Banks use a similar model by issuing reward points. You spend through a credit card, earn points, and exchange them for gifts, sometimes even for high-value items like phones, computers, or cars. In short, money is anything that can do two things: act as a medium of exchange and a measure of value. If a community believes in the value of something and uses it to trade, that item becomes money. This explains why Bitcoin, a digital currency not backed by any government, still has value and continues to grow. The more people believe in it, the greater its value becomes. This is a key principle in the digital age. Collective belief can create real value. In today's world, a successful business doesn't just have customers, it has fans. Apple has Apple fans. Xiaomi has my fans. Smart businesses turn customers into loyal supporters, and those fans help spread value, build closed ecosystems, and maintain both cash flow and trust in the brand. So, money is no longer just what you hold in your hand, it's the trust you build with a community and the ecosystem you create. One of the smartest strategies of the wealthy is knowing how to turn money into appreciating assets. A prime example is real estate investing. But it's not just about buying land or houses. They often don't buy under their personal names, but under companies as part of a long-term financial strategy. When assets like land are owned by a business entity, that company can revalue the asset annually. If the land value doubles every year, the company can report that increase in its financial statements, showing steady profit growth. This, in turn, raises the company's valuation, especially if it plans to list on the stock exchange. Meanwhile, those who lack financial knowledge might leave cash in a bank account for 3 years, generating little or no return. That's dead money. The wealthy, by revaluing assets, can create profits without ever needing to sell anything. Another tax optimization tactic involves asset depreciation. For example, a businessperson could purchase a $50 million painting under their company's name. The painting is recorded as a fixed asset and depreciated over 5 years. Each year, the company books $10 million in depreciation expenses. If revenue is $10 million, then profit becomes zero and no corporate income tax is owed. After 5 years, the painting's book value is almost zero. At that point, the business owner can buy it back from the company for $1, transferring it from corporate to personal ownership. This is a sophisticated but completely legal asset transfer strategy. This allows the rich to retain ownership, minimize taxes, and preserve wealth. In contrast, those who don't understand the rules simply pay taxes passively according to the law. Therefore, if you truly want to build wealth, you don't just need money, you need financial knowledge, legal understanding, and strategic asset management. The wealthy don't get rich by saving, they get rich by using systems to optimize their assets and cash flow. One often overlooked but crucial aspect of building wealth is the ability to capitalize on brand value and intangible assets. This is the leverage used by large corporations, billionaires, and professional investors to multiply their assets dramatically. Imagine you own a company with $10 million in tangible assets, factories, machinery, cash, etc. If the founder is a well-known, respected figure whom investors trust, that company could be valued at $100 million or even $1 billion after just one funding round. Why such a large gap? That's the monetized value of brand, trust, and growth potential. This explains why people like Donald Trump, Elon Musk, or celebrities can raise capital with ease. It's not because they hold vast amounts of cash, but because their names inspire market confidence, which raises the valuation of their companies. Tangible assets are only a small piece of the puzzle. Intangible and financial assets make up the majority of what investors care about. We often think a company's value equals total assets minus liabilities. In reality, the stock market values companies based on future profit potential and who's behind business. That's why two companies with identical $10 million assets can be valued vastly differently. An unknown brand is undervalued, while a business backed by a famous founder can be worth many times more. The key lesson here: if you want to multiply your net worth, don't just focus on accumulating physical assets. Build a personal brand, establish trust, and learn to capitalize on intangibles like reputation, community, vision, and growth potential. Even with just a few thousand loyal followers, you can launch a startup with a high market capitalization. That's why in this era, influencers, visionary founders, and entrepreneurs with their own ecosystems can easily raise funds and build million-dollar companies, even from humble beginnings. So, reassess your asset model. You might have $10 million in cash, but if you can convert that into financial assets and combine it with a strong personal brand and a supportive community, you could turn it into a $100 million company. That is the power of brand capitalization in today's financial markets. We are living in an era of unprecedented speed of change. Digital technology, artificial intelligence AI, blockchain, and the metaverse are no longer distant dreams, they are becoming reality, transforming how we live, work, and make money. Who would have imagined, just a decade ago, that with nothing more than a smartphone, you could run a business, teach classes, or manage a global company? That today, it's entirely normal. The COVID-19 pandemic accelerated digital transformation, forcing many traditional businesses to shift online. This is not a temporary trend, but a launchpad for a full-scale digital revolution. The metaverse, a virtual universe, is seen as the next frontier where people interact, entertain, trade, and even work. In this virtual environment, digital assets, digital identities, and cryptocurrencies will become the main mediums of exchange. This requires us to rethink the definition of value and assets. Those who are quick to adapt will see this as an unprecedented opportunity to create wealth from zero. You can build digital products, create content, or even own virtual real estate. As more people enter the space, the value of assets in the metaverse will rise, following the basic law of supply and demand. However, not everyone is ready to adapt. The difference between those who thrive in the digital age and those left behind is not technology, it's mindset. Those with an open mind, a willingness to learn, and the discipline to invest time and effort into adapting will gain a significant early advantage. Examples like Alibaba, Shopee, TikTok Shop, YouTube, or Facebook Marketplace prove that online business models not only compete but dominate. If you're still relying entirely on traditional business models, you're at serious risk of being left behind. So from today, invest in technological literacy, digital skills, build an online personal brand, and seize opportunities in the metaverse, NFTs, AI, and blockchain. Don't wait until the whole world is already in the game to start learning. By then, the biggest opportunities will have already been claimed. Success in the digital era doesn't belong to the hesitant. It belongs to those who dare to change, step out of their comfort zones, and harness technology to create personal wealth. At this point, a clear truth should emerge. Money is not just something you earn with labor, it's something you create through mindset, systems, and smart strategy. The modern world operates by new rules, where financial literacy, technological adaptability, and asset capitalization thinking are the ultimate tools of power. If you simply hold onto your money and hope for safety, you're letting it erode slowly through inflation. If you don't understand the real value of assets and how to leverage systems to optimize tax, cash flow, and capital, you'll always be on the defensive side of the financial game. So starting today, take these practical steps. Shift your mindset about money. See it as a tool, not the goal. Focus on keeping your cash flow alive and growing. Learn about finance and market dynamics. Understanding how taxes, financial leverage, intangible assets, and market capitalization work is key to building sustainable wealth. Start a business or own one. Even a small business allows you to think like a capitalist, build systems, and optimize advantage. Build your personal brand. In the digital world, your reputation can be monetized. Your audience may become your most valuable asset. Invest in tech and digital transformation. Don't miss out on the metaverse, blockchain, and AI. These are the breeding grounds of future billionaires. Never stop learning and adapting. Every crisis or tech shift is an opportunity for those who are better prepared. Wealth doesn't come from luck. It comes from a deep understanding of how the world works and taking strategic action based on those rules. If you stay committed to this path, you won't just earn money, you'll take control of it. This isn't a theoretical lecture. This is a real-world roadmap to financial freedom. We hope these insights will bring you luck and success in life. Thank you and see you again.